This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Bishoy Habib with Levacy Legal. We're going to be talking about something that is very topical to really all investors in the real estate realm, especially those of you that are interested in commercial real estate. One nice thing about real estate is it's a dynamic thing to invest in, right? It's not going to always remain static, and the opportunity for creating value or finding value is always changing. The counterpoint to that argument is that the issues are always going to be changing as well. And especially if you're going to be investing your money into commercial real estate and kind of turning over your capital to be stewarded by other people, the issues and things that you need to look out for on your due diligence side of things, again, are always going to be changing. The issues that might have arisen 5, 6, 7, 10 years ago are different than the ones that maybe were 3 or 4 years ago, and certainly might be even different than the ones that are occurring today. Now, certainly there are always going to be, things that are going to be common between all of those. Is this, a development that's going to be somewhere that can support the actual tenants that you're looking to have in there? Putting a 5-star assisted living facility in the middle of rural Mississippi, maybe not necessarily the best play. But again, the high level stuff can always kind of be gleaned, but the devil is always going to be in the details, and having a legal mind on our podcast today that can kind of elucidate to some of those is always very well received. So thank you very much for being on with us today. I always like to have our guests give a little bit of their own background. You're better to tell us about yourself than I ever would imagine to be. So thank you very much for being on with us, and give us a little bit of your background, kind of how you came to be in your current franchise and what you do in your legal practice and how you got involved in real estate.
Absolutely. Well, first off, thanks for having me on the show, Alex. I appreciate you. My neighbor here in the Tampa Bay area. And so I am, so my name is Bishoy Habib. As you said, I am a real estate attorney. I've been doing it for 12 years now. In addition to being a real estate attorney, I am an investor as well. And I think that helps me. And I also am a broker. So I have a brokerage called Capstar Real Estate with 20 agents here in Tampa Bay. And so, my journey begins back in, I don't know, when I was a kid. I don't remember when, but my dad was a part-time turned full-time real estate investor. He's an immigrant, learned how to do it, and learned that the path to financial freedom was in real estate at an early time. And so, growing up in real estate, growing up and kind of seeing my dad have properties, drive to those properties, manage the properties, things like that was impactful to me, because I always liked how he controlled his own time. He worked a lot, but he controlled his own schedule, his own time. He didn't have to report to anyone. I always thought that was pretty neat, even at a young age. And so I always was like, well, I like that more than what mom does. And mom was a dentist, but I just didn't like her rigid schedule and, other things about it. So I ended up kind of just following that. When I was 15, I helped him negotiate. I negotiated my first commercial lease, is what I tell people, but I don't know how much I really did, but pretty cool. In one of his buildings with the state of Florida as the tenant. So that was like a high for me. I decided to go to, I always wanted to be on the transactional side of real estate. I decided to go to law school to get my law degree and my MBA as well, just because I figured that would make me more marketable and also give me an edge up on anybody else doing real estate. So when I graduated law school in 2012, the market was pretty much at the bottom at that point. If we could go back in time, we would have just bought everything in 2012, but we didn't know that. It felt different in the moment, right? So I was like, well, let me go practice law then. I didn't really intend to practice law, but you got the degree, might as well go do it, right? Because that's what's going to pay me right now. So I went, I got a job in New York City with the largest hotel developer in Manhattan as my biggest client, or the firm's biggest client. And so, just seeing $100 million hotel deals from start to finish, the entire cycle, was really a phenomenal opportunity for me as a kid who grew up in, Orlando. Like, I didn't we didn't have really deals like that happening in Orlando at the time, or Tampa. So, to see everything from, the acquisition of the land, the construction loan, the land lease, the refinance, the disposition. I mean, the whole life cycle of it was an incredible opportunity. I moved back to Florida a few years later for personal reasons. So I got licensed in New York, and then I moved back here. And that's where I've been ever since, Tampa, practicing real estate law and finance law as well for a period of time over the last 10 years. So what I focus on is transactional real estate. So I represent builders, I represent investors, I represent lenders, all in their transactional real estate. So I've closed over 1,000 deals. And, for me, the name of the game is how do we maximize profits and limit liability?
No, absolutely. It's kind of it's always interesting to talk to people in my kind of peer circle that had a similar career trajectory. I came into the investment world beginning of 2012 as well, on the retirement plan acquisition side of things for buying. Almost all of it was real estate at that point in my career. Probably had a hand in. I did the calculations. I know the total number of transactional deals were probably well over $100 million worth of real estate in that first 5 years of my career when I was on that side of the table. And it was really interesting to see, like, again, to your point of saying, yeah, if we were back then, like, everyone had been buying property, I was getting to handle the people that were, all out there just trying to, scrape through all of the REO bankrolls and, get all the foreclosures. And it put a little bit of a bad taste in my mouth on seeing what the commercial banking side of things was doing with all of those properties, and how they were just clinging on to them and not getting them back out there, and just creating this, kind of cyclical issue of, dilapidated properties, blighted neighborhoods where investors were trying to come in and grab them. But that's a conversation for another podcast. But again, interesting to kind of see where people kind of came out in the same, area, because it was tough. I was surprised to have landed a career in finance at that interesting time in the economy, but hey, it worked out. I'm here now, right? We're talking to each other.
Exactly.
So, it's something that, again, looking at it back then, there really wasn't, up until maybe, at least from my perspective, there wasn't a ton of focus, at least on, and, things like the Jobs Act were still relatively new. I think that was legislated in 2013, correct? Where it kind of opened the gates for people to do, people like to always look at it as the crowdfunding legislation, but it's really a lot more than that. It opened up the keys of the kingdom to a lot of people to syndicate partnerships for commercial real estate development. So you have a lot more stuff kind of coming from that point of view, or that point in time, that would allow more of the masses. I mean, granted, most of the deals you have to be accredited, but it did also up, the opportunity for not accredited investors as well for certain deals legislated under different acts. But, the issues that we were looking at back then certainly were a lot different. Again, to the point of the luxury retirement home in the middle of rural Mississippi, being maybe not the best play. But again, the issues that we're looking at back then. So, let's kind of maybe start a basis of, due diligence things that, are kind of across the board. They kind of live in perpetuity, if you will, of things that are high level that, it didn't matter if it was, to think of how long ago 2013 was is also odd. But, going back to kind of when the, this whole new opportunity for people to kind of get into commercial real estate came about, what are, again, some of the high level stuff that really is always things that people should be looking at and that you see from a legal perspective?
Yeah, there has been, you touched on a really good point, which is the crowd sourcing platforms that have really made it, virtually, no barrier to entry in real estate anymore, right? And it's a good thing. And it's, I don't remember the name of that company that, tokenized like homes, and you could buy like a share of a home for like $100. I mean, that was kind of weird to me, but the idea is that anybody now is a real estate investor, and the technology that's, to where you can invest $1,000 and own a piece technically of some real estate, or a company that owns the real estate, I mean, is really astounding. For me, what I always tell my clients is the most important thing you need to do is vet the sponsors or the general partners. That's the first step. Don't even look at the deal until you know who's putting the deal together. We have enough hindsight now to see that what's happened in 2021 and 2020, a lot of those investors and partners and syndications who were doing things that didn't even make sense in any context, but overbidding on properties, underwriting extremely aggressively, as if rates were going to continue going up 10, rents were going to continue going up 10% a year, and everything else, all their expenses were going to stay at 3% a year. And it was never, the gravy train was never going to end. All those people now are being exposed, and all those people now, there's a lot of fraud that's being exposed by those guarantors and sponsors. There's a lot of misallocated funds. The deals are not penciling in because the insurance, and I'm in Florida here, so let's talk about insurance. The insurance has doubled or tripled, and that's before we just got, knocked by these last two storms. It's going to keep going up. Obviously, the price of everything has gone up. The interest rates have doubled or tripled depending on where you were. And so I say all that to say the most important thing when you're investing in real estate, as a limited partner, as just somebody who's new in the game, is who you're investing with, right? So don't underestimate that. Dive in, ask questions. How much equity do they have in this? How much money are they putting in? Not sweat equity. How much actual money are they putting? How much skin in the game do they have? What's their track record? Are they personally guaranteeing the loans? These are all really important things. Once you get past that, then I think you can look at the deal, right? And then you have to just judge the deal. And I think for my investors, I say, or my clients, I say, like, if you need help, that's something that you can get help on, because people like me and you, we love looking at a deal and telling you, like, hey, this kind of sounds cool, or I don't know, what about, this, that, this, competing property here, then where the comps are 20% lower, like, what do we, how do they justify that, right? So I think people who are in the business, the deal junkies, like, it's always easy to just ask an opinion. Nobody's, we like looking at deals. So I think dissecting the deal is the second most important thing. But I always tell people, the sponsors and the people behind it, are they going to do the things they say? When things get tough, what are they going to do? And, are they legitimate? I mean, again, a lot of, weird things happen when the market is going well. People do weird things and then they don't get caught until the market kind of comes back down to reality, which is what's happening now. So yeah. I think those are two of the big things on a high level.
Yeah, and there's two things that you brought up that I'd like to add a little bit of color to, is that, again, I'm 100% agreements that the first thing you need to do is understand that in commercial real estate, unlike residential single family, and again, there are investment providers that, you can invest with, like a company that goes and buys single family. But again, generally in single family, you're looking at that property. You're probably the one going out and buying it, doing your own due diligence. You're looking at that property specifically. And the only person you really have to answer to is yourself, or maybe a few partners that you are doing it with. So understanding that in these kind of situations, you're dealing with a lot more money. There's more complexity, and the people that are putting this together are really who you need to be comfortable with, because once you write that check, it's in their hands to steward that capital in an effective and, hopefully profitable manner. So a few high points that I always tell people is, like, look at their track record, like you said. Go out and make sure you're comfortable with what they've done. Look at, and again, the kind of the sterilized package thing is that, past performance is not indicative of future gains. But it holds true. But, you have to have some track record to say, hey, look, they at least know what they're doing. We all want to, look at the people and say, hey, look, they're working hard. It's their first deal. I'd like to, help them out. Again, maybe wait to the more inexperienced people. Everyone has to start somewhere, but, maybe get a few deals under your belt in doing this before you start going into the people that are just getting started. I didn't know anything about retirement plans and benefit plans and IRAs and tax code until I started somewhere, right? And, you had your first day in law school too, and you had your first client as well. But everyone starts somewhere, but you want to be that, test case for them. And then also, to your point about, finding the cracks in the foundation, the way that commercial real estate works is that, again, someone can be, have done this well. And at least for the past 10 years, almost, with the way the markets went, it's, people could do a lot of things that, you don't really start seeing the cracks in the foundation until now.
Yeah.
It's, you know, things, especially, even up until maybe 2022, when we really start seeing the rates start going way up and expenses start getting exposed as being something that's not just going to be a static, 3% with a 0.5% float. It's, it's something to see. And the way that commercial real estate works is that a deal can be underwritten and look good for the first few years, but now we're starting to see the cracks come to fruition because you have these 4 or 5 year runoffs where the prospectus is saying, hey, here's our ideal timeline for our reposition, refinance X, Y, and Z. Now you're starting to see those, the walls kind of start moving in, and issues start happening. So it's not an immediate thing like the stock market. When you're dealing with this, it's not something where you say, oh well, look, the price went down and all this other stuff. It takes a while for the issues to matriculate. So again, really good points. And some of the beginning stuff for people seems simple, and it is, and that's a good thing. Be comfortable with who you're investing in. Have they done this before? What's their track record like? Are they personally guaranteeing stuff? How much money do they have in the game? And while this does seem simple, it is. And it's also good to know, because if you can't do the simple things effectively, then the more complex stuff is going to be that much more complex. So great way to start out. I'm again in 100% agreements on that. So maybe let's start looking at maybe a few of the things that are a little bit more nuanced with this. And I think it's probably important for people to understand, kind of how the structure works. You have in partnerships, generally, you have people that come in, the rank and file investors are going to be your limited partners. But, you have the quote unquote management, or the people that you're really giving the money to on the general partner side, often referred to as the GP. What are some things, again, that, people should look at saying, hey, like, who are the main characters in this cast of, who you should be asking the questions to? What things might be a red flag when you look at the corporate governance, again, using the term lightly, when it comes to these types of investments?
So it's a great question, and we'll dive into it a little bit. So I think I want to kind of bifurcate into two different kinds of limited investment, right? So the first kind of limited investment is like a big syndication for, let's just say a $50 million property or $20 million property, whatever, where you're just a small piece of it. And there's a ton of other investors, and it's not really up for negotiation. It's like, here's our prospectus. These are our terms, and, it's take it or leave it, right? That's one option. The other option is, let's make it a little bit more, a lower threshold, right? And so it's me and you and maybe one other person going in on this commercial building, and it's a $2 million building, and maybe you source the deal and you're going to manage it, and you want my money, right? And the other partner's money, whatever. It's a much more simple thing, but you also have more leverage in that situation. I as the investor have more leverage in that situation. So when we talk about the situation where it's a bigger syndication or bigger fund and you don't have any really control, and it's more of a take it or leave it proposition, you want to make sure that that the fees are in line, right? And whatever that means to you, I'm not telling you what is or isn't, but I've seen some pretty ridiculous fees. You just want to make sure you understand what those are. They'll get you on the way in, they'll get you on the way out, they'll get you on a refinance. And I'm not saying that the managers aren't worth all that. You just have to understand, does that make sense for you? Because a lot of times it may be disclosed technically in the prospectus, but it's confusing. So you have to really make sure you understand the numbers. With something like this, what happens if the main partner dies, right? There's usually some sort of a, or becomes incapacitated, right? Or does something that they shouldn't do. What happens in that event? So those are a couple of things that you want to look at outside the actual deal. The reality is, with a deal like this in a big syndication or big fund, you're not going to be able to negotiate too much. Now, if you came and you're the biggest investor, we can negotiate anything. But if you're coming in with 100,000 and it's a $25 million fund, they're not going to change anything for what you want, right? In this case, if you're coming to me with the smallest investment, what I'm going to do is I'm going to review the prospectus for you as your attorney, and I'm going to say, look, these are the things you need to be aware of. They are saying, that you may not get your money for 10 years. You understand that, right? They have no intention to sell for 10 years. Are you okay with that time frame, right? So, just pointing out different things. I think with the kind of this deal where it's me and you, it's a lot more open for negotiation, and it becomes, I could do more damage here, right? Because then I could say, look, if you mismanage this, we can put in clauses that say, if you, Alex, you mismanage this property, then I can take it over, right? Or if it's not cash flowing X amount per year, or if we're not hitting our ratios, right, our debt service coverage ratios, or whatever I want to say, then we are going to replace you with a third-party manager of my choice. Or if I have experience, maybe I want to take over and manage the property myself, right? Which a lot of money guys don't, but I'm just saying. You also want to make sure that that this person is there's some oversight in what they're doing, because again, if you're not watching them, nobody is, right? If it's just you two. So you want to make sure you're getting financials on a regular basis. You want to make sure you have access to the bank accounts. You want to make sure that you have control of your money as much as you can. I mean, because what you said it a minute ago, once you let that money go, it's gone, but you can still put parameters in place to at least safeguard you to some extent. What I try to do is I try to tie things to performance. So as long as we're cash flowing and as long as we're making money, this manager has leeway. But if we slow down and if the, certain metrics aren't met, then all of a sudden we have to revisit and see, why is it not happening? And obviously not everything is the manager's fault. Not everything's in the manager's control, but sometimes it is, sometimes it is. So, for me, it's all about how much leverage do we have. If I'm representing a client who's investing, how much leverage do we have? It's always the first question. If we have a lot of leverage, we're going to push as much as we can. And if we don't, we're going to at least point to that investor some of the important things that they need to be aware of if they're going to make this investment.
Yeah, absolutely. And those are fantastic points. One thing you brought up that I think it definitely bears some additional explanation is fees. I am a firm believer that anytime that someone adds value, there should be some reciprocal value that is given. Whether that is a legal opinion or what I do on my side. I just interviewed a great tax advisor yesterday, and kind of culturally, at least here, is that we've gotten so used to things being quote free. The Amazon effect. It's free shipping. It's not free shipping. And these people that are hopefully going to be generating you returns on your investment should certainly be compensated. They're and to the point of they should be able to make a good living doing this, and most of them certainly do. But fees do have a limit as to when they start becoming, egregious or maybe not necessarily in line with what is in the best interest of the management of the company. But again, that's, some of that is, again, a little bit too far in the weeds for, I think, what we want to talk about at a high level. But I think it kind of would be good for people to hear from you of what are some kind of normal fees that are paid. Is it certainly there's an ongoing management fee for the service that the general partners and managers provide. There might be a fee for the initial investment or things like equalization payments for certain types of funds. But again, there might be some things that are creeping in that, again, you're talking about like, additional fees being paid on refinances or other triggers that might trigger fees that, again, just are things for people to look at. And if you're comfortable with it, great. If you feel that they are really adding value and earning that fee, but, certainly some things might be creeping in. So maybe at a high level, talk about, what are some kind of normal fees that people might see, because, people coming into this for the first time, you go onto Fidelity or Charles Schwab and you buy a bunch of securities. Well, hey, that was a free trade. Well, no, there's a bid and ask, and there's a reason that Fidelity is $1 billion company. There's not a red cross in front of their window. It's because they're making money somehow. There's nothing free, right? So again, just talking about some of the normal fees that people might see, and then also a few things that say, hey, like give some pause, do some research, figuring out if this is a good fit for you.
I get leery when someone says, give me like a normal fee, because, give me an example of a normal fees, because there's no such thing. So, in a hypothetical, I'll just use an extreme example. If I told you, I would give you 30% year over year, annual returns, nobody's saying no to that, right? What if I was making 40% and you were making 30%? Would that piss you off? Would you not invest? Would it matter? If I was giving you, 10% and I was making 40%, would you feel differently? You know what I mean? Even if you were fine with that 10%. And I think I don't know if that's the best way to illustrate what I'm trying to say, but the point I'm trying to make is like, it's really everyone's own discretion on what they feel comfortable with. And so I think part of what I try actively every single time I'm engaged with a client to do is to not tell them what's a good or a bad deal unless they specifically want to know from me, and not to tell them this is a ripoff or this is a great deal. I try not to cross that line again, unless they ask my opinion, which a lot of them do. They say, do you like the deal or not? But my responsibility, I feel, as an attorney is more so to guide them, to say, look, did you know that every time they refinance, they get 2 points? I mean, that's, on a $20 million loan, that's $400,000, right? Like, did you know that? As long as you know that, because that's your money. That's your money, right? That's money that should be going in your pocket or could be going in your pocket. So, what's a normal fee? What's an acceptable fee? I mean, it's just, I don't feel comfortable saying what is a good fee and what's not. Everybody's situation is different. Some guys are just super happy to get a 5 or a 6% return on their money every year and not have to think about it. Some people want, 20% and some upside. I mean, it's just your discretion. It's just where you are in your cycle as an investor. If you're maybe later on and you're just trying to, you don't care as much about the fees. You just want something steady, like a triple net. Or if you're early on and you're aggressive and you're trying to make, maximize every dollar. So I think that would be my response to that.
No, and I might have phrased the question incorrectly. I wasn't trying to so much to get like the opinion of like, hey, what is a good or a bad fee as like a metric of like the ratio of saying, hey, if you're making 20 and they're making 30, are you okay with it? More just kind of like what the fees are, right? Like saying like, hey, like here's like what like people like normally charge, and not a number, just like this, like what you would see is like, okay, management, okay, acquisition, like points on something. Like what are just some of the fees that people might see itemized? And again, I completely agree with you that you have to be okay with those fees. Are they adding enough value to where you're okay with whatever the spread is? And I think that's really what people should look at. And again, to your point about aggressiveness or, trying to be conservative, that all plays into a personal decision. And, if you're not comfortable making that, hire someone that's capable and ideally legally able to give you that opinion for your own personal discretion. But again, just high level of like what the fees, just like what the itemized are, not the amounts per se or the ratios.
Yeah, I mean, some common ones you kind of touched on is the acquisition fee, right? They'll get a fee when they close on the property. Refinance fee, they'll get a fee when they refinance. They'll get a disposition fee when they dispo the property. They will, so when we talk about waterfall structures, once they hit certain metrics, they may be entitled to a higher percentage or more fees, or, we could have structures where you plateau as an investor, so you can only make X amount per year or lifetime, and then the rest of that money gets diverted to the general partners. There was one more I was going to say, but those are general fees, and then of course a management fee. You just have to understand that the goal is to align their interest with yours as much as possible. A management fee is going to get paid regardless of the performance of the property, right? That's a top line item. So, I like to lower the management fee and increase the upside to the general partner as much as possible, because that way our interests are more aligned, but it doesn't always work out that way. So, it's just kind of my thoughts on the high level, kind of some of the fees that I see on a regular basis.
Yeah, and again, that's kind of what I was getting at. Again,
sure.
Again, to the point of saying, everyone, you have to be comfortable with what you're doing, and look at how it aligns kind of with the interests of everyone. Are the fees that are being paid to the management in line with the performance of the property? So they have a vested interest in making sure that this thing performs as well as possible. Are they being compensated at a disproportionate rate to the investors? Are they the only ones that are capturing the upside with the performance of the property and not necessarily the investors? Or is that ratio allocation capped in some way? Again, not to say that's good, bad, or indifferent. If you're comfortable with the returns and everything, then by all means. But again, I think people, from our, kind of both of our statements can see where there might be some issues if things, again, aren't aligned with if the performance and your interest aren't necessarily aligned with the management, then again, that's definitely something to take a closer look at, maybe with an attorney or someone that can advise you on that deal specific structure.
Yeah.
And then, okay, so kind of going in from fees again, understanding who you're investing with, understanding the fees and kind of, just, again, there's nothing free, how that works. Then with regard to some things like, let's say, still seeing on the kind of the management structure, how would you maybe necessarily recommend people kind of glean this information? Because you'll get a prospectus that'll, it's all nice and polished, but remember, this is written by, the attorneys that are engaged by the management to promote the investment that they're offering, right? So that's where it's coming from, and it again legally is going to have to disclose a lot of information. Again, that's kind of a conversation you know at a deep level for another day. But how do people kind of go about doing this? Is it just calling them up on the phone and saying, hey, give me XYZ? What are some things maybe that you read through the prospectus, and then how do you kind of navigate then going and asking these kind of more hard-hitting questions to the actual managers or general partners that you're investing with to get the information to make those decisions with?
Yeah, so the prospectus could be a whole conversation. I did when I was working, I worked a job when I first moved back to Tampa at a firm that focused on finance law, right? And so there was some real estate in it, but a lot of it was finance. And so what we did was, um, at one point I did $1 billion deal for the Orlando airport here. Actually, it was a multi-billion dollar deal, but each tranche was $1 billion. So, but that wasn't an average deal size. It was, 9 figures. It could be 100 million, could be 50, could be 300 million. But the point is, part of what we were tasked with was preparing those prospectuses or, offering memorandums. They all have different names, but they're all the same in theory. Half of my job was preparing them, and then half of them was reviewing them, from the other side, right? So it was both sides. They are very scary documents. They are very intimidating documents. And if you're dealing with the big boys and you're dealing with a big investment and a big group, you are going to get a scary document. Why is it scary? First of all, it's intimidating. It's very long, and it has a lot of legal jargon in a very small print that is hard to understand, hard to read, hard to comprehend. It's like a different language. And I'm telling you, I'm an attorney, and those things are hard to read, even for me. And I've put them together, So I would never expect a layperson to read a whole prospectus if it's like the size that I'm used to dealing with. So let's just off the bat say that you probably need some sort of help if you really want to understand this. You're not going to understand it if you're a layperson, because it's really not, and the only intent of it is to comply with regulations, right? That's the only reason people put the perspective. It's a CYA. I mean, it's a marketing tool, but it's more than that. It's a CYA. The perspectives is interesting because it's this dynamic of, this is the best investment in the world, and then you get halfway through and then you get to the risks section and it says, this is the worst investment in the world. Potentially you're going to lose all your money and it's never going to pan out because these are the possible risks. And then it just lists every possible. Our job was literally to find every scary possible thing that could happen in the history of the world that could derail this. Why? Because it's a CYA. So the more you put in there, the more you're protecting yourself as the group that's collecting the money, the GPs in this case. So don't get too high on this part. Don't get too scared on this part. And you just have to be able to discern, like get through the highs and the lows and kind of the fluff, and then really discern, what is this really saying? What does this really mean? What's the actual upside? What's the actual downside? That takes somebody who's read or written 100 of these to really kind of see through. They are very intimidating. They're very one-sided documents, like I said. So, for me, if someone retains me, I can kind of sift through it and understand, what do we need to harp on? What is standard language? And then just focus on like a few key points to the client, or my client or the investor, is like, what's very important to you? Why do you like this deal? What are you worried about? And what are your goals in investing? With that information, that's the framework that I then read that document with, and then we'll have conversations, and then we can go back to the sponsor. Hey, can you clarify what this means? Hey, you said this here, and that kind of contradicts with this. Can you explain why that is? Hey, are you open to adding this language in here to protect my guy? Just things like that. And we go back and forth, and it comes back to one thing: leverage. If you have leverage, they'll have that conversation with you. If you're investing, $100,000 on a $25 million fund, they're probably not going to respond to you. So that's the kind of the cycle of how that all works. That is one thing that I would not recommend anyone do on their own. And I'll tell you, if I don't think you need an attorney, you don't need an attorney. You should have an attorney if you're going to invest a good amount of money to review the prospectus if you're not already someone who's extremely familiar with those documents.
Yeah, and that's a really great point. And a few points that I would like to elucidate on too are that, and you touch on, is that if you are the smallest fish in a big pond, the investment provider should, again, you should be able to get your questions answered, but just keep in mind that there's a psychological component to this, good, bad, or indifferent. If there's $20 million of investors and you have 100 grand coming in there, 15 phone calls to them, you might start getting some short answers. And that's just the case. And it's not good, but again, that's just the use case.
Or you might get no answers, because you know why? Because the guys who put in the least money are always the most work. That's what they say. That's what they say. I'm just putting it out there. Sponsors know it. The guy who puts in the minimum 25,000, 50,000, 100,000, that's the guy that's going to call you every week for an update, or every month for an update, because that money just means a lot more than the guy who's like, all right, I'll wire you $1 million. What's your wiring information? I don't need to see the prospectus, right?
Yeah.
That guy's not going he won't bother you for 2 years. You know what I mean? So
exactly. And to that point, if you are investing in a larger syndication and, it's, you might get, again, one or two of those phone calls answered, paying the money to have an attorney that can kind of distill down what the real questions are that you need to ask them and feel comfortable with for your own personal due diligence. Because I always recommend people too, do some of this yourself, get familiar with talking to these people and understanding it. Because again, to the very beginning point, you're turning over your money as to steward your capital. So again, maybe having that to where you can say, okay, cool. Well, now I can use my phone call to say, hey, X, Y, and Z, 1, 2, 3, 4, want to do my due diligence. Again, the 15 phone calls, they might not even pick up the phone at that point. Again, if you are proportionally a larger investor, maybe in a smaller deal, or just a bigger investor in a big deal, again, some of those interactions might go a little bit differently. So again, that's something at least just, that I tell people to look at. And then something at least anecdotally that I've seen, to that prospectus and the PPM and everything that's provided, you'll have, again, kind of the more marketing side of things saying, hey, here's why this is amazing and awesome. And then you have the risk section. And again, ideally those, should be, at least from the content side, similar. You'd like to see kind of every awesome point, maybe countered by something bad, because, everything good has something that could affect it being good. If you see something maybe at a high level that is like 2 paragraphs of bad things, but, 5 or 15 pages of amazing, awesome stuff. Again, not that it's bad, but talk to an attorney or someone that can advise you, say, hey, is this legitimate? Do you think they really are covering their basis on the full disclosures of everything? Especially in a market where we maybe have people trying to make things pencil that otherwise wouldn't in a normal, again, I say normal, but the economy is always changing. Everyone's like, this isn't normal, but they've been saying this isn't normal for 50 years. So I don't really give much credence to that. But again, just understanding that, people out here, especially when times get tough, there's more propensity for things that are, in your best interest. So having an attorney that can look at it and say, okay, yeah, this isn't a problem. It's just, kind of how it was written, or maybe saying, hey, they're really kind of being thin on what they think might go wrong with this. It's, they're building a new hotel on St. Pete Beach. It's like, oh yeah, flooding shouldn't be an issue. And I think that was well proved that it certainly wasn't. So again, that's just kind of anecdotally from what I've seen. I haven't seen that come up. I just read through another one yesterday, and it all seemed kind of in line with what I've seen over the past, 12 years of doing this. So just, again, some things to look at. It's just, ideally SEC attorneys legally should be involved in the drafting of these documents and, putting them together. And you would hope that the attorney is acting in everyone's best interest in doing it correctly. But, attorneys get arrested just like everyone else for doing that aren't great. So do bankers. So do investment managers. You're dealing with a human component to all this, which is important to remember. It's not a computer. It's not just like a big thing. It's not, while it can be very, ethereal in nature sometimes when you're dealing with finance, there's people involved, and understand that the human component, good, bad, and different, does come into play in this whole thing.
Yeah,
Um,
absolutely.
Now, some other things that, again, are, kind of to shift focus on, like, okay, you have, the due diligence part of like understanding who you're investing with. You have the disclosures that are given to you to kind of, the framework of what you need to do to build your investment house, and the questions you need to ask to the people that are building it. We've gotten to there. Now what I'd kind of like to pick your brain on a little bit is maybe some things that are cropping up that are maybe some like really small ones, that you wouldn't necessarily know to think that could be an issue. That can be. The one that comes to mind is something I've seen, and clients don't necessarily know the difference, but when you get one of these investments, they're going to detail how they pay you, right? You're going to get typically a preferred return on your capital, and it's going to be paid out at X% minus expenses, going forward. Maybe there's a cap on that, maybe not. But one thing I've seen, in the past few years, is that some investment providers, and again, this could be good for their structure, it could be bad. It's up to you to determine the efficacy of this for your goals, is changing something like return on capital to return of capital, in an investment prospectus, which some clients might say, okay, cool, well, I get paid out X amount of money, but that small change, and again, maybe it just illustrates a bigger issue, is that if you're getting a return on your capital, great, you have your basis in the property, it returns X, and then when it sells, you get your basis back plus whatever attributable earnings, right? Return of capital means that they're basically drawing down your basis in that investment until maybe it's zero at one point, but you're getting a return, your return plus a reduction in your capital, kind of like a principal and interest loan. It's like an analog. Again, not that this is a loan to them, but again, small details can change things, and hopefully they're doing it in everyone's best interest. But things to watch for, things that might be changing, is kind of the point I was trying to make with that. Anything that you're seeing, and maybe you have some thoughts on to elucidate on that point as well, but maybe some small things that are changing to really kind of be aware of and understand that grammar really matters in these documents.
I think the one that you just brought up, I had seen, and I honestly thought that that was a mistake or a typo, and I
Yeah.
pointed it out to them, and I was surprised to find out it wasn't. It almost, I don't know, it felt sneaky to me, but I don't know if that's kind of the way things are going now. I I pride myself on being a deal making attorney, but at the end of the day, sometimes it does. You do have to understand that your interests don't align with the interest of the guarantor of the GPs, of the general partners. They don't like, and you want to try to align them as much as possible, but at the end of the day, that's not always the case, and so things like this exemplify that. I So what ended up happening with that? I mean, is that something that, how often are you seeing that? I guess is probably a better question.
Very infrequently, and honestly, it was one of
Yeah.
those things where I had interviewed another, attorney out of Tennessee that even made me aware of it. I was like, I didn't even think, it's like he's like his exact question to me is like, what do you think the difference between return on capital and return of capital was? And I was just thinking, like, well, okay, let's. He's asking me this question for a reason, right? It's not just as simple as I
Yeah.
think. I'm like, well, I think of, refinance, return of capital to investors. I'm like, that's where I've seen that before. Or some type of acquisition of the property. Okay, it's return of capital there. And then your pref being paid out. Okay, that's return, on capital. And he's like, well, think about if you were to exchange that to when you're talking about the preferred returns and the rates of returns. If you were to say return of capital in there, I'm like, well, wow, that means that they're returning their capital plus returns. I'm like, that doesn't make sense. He goes, it can. And for the life of me, I can't remember some of the instances that he gave. It's like, well, here's why they might do that. But again, to your point, it's we're so used to seeing things done one way for so long that putting it in there again, and not necessarily being like, hey, like big bold letters, like this is how it's being done and it's different. Again, it's, was there any type of malintent? I don't know. I think I've only seen it once. And the
Yeah.
client even brought it. He was like, okay, cool. Yeah, this is why they're doing it. And they were a little bit more forthcoming. But to your point of the one you saw, it wasn't as forthcoming, right? It was like, is that a typo? Like, did they just, were
And
they? were they using Grammarly and it just messed it up? Like, what was going on?
And the thing about it is they're not doing anything illegal, right? Like I'm not faulting the GP or the GP's attorneys for trying to get, I don't want to say sneaky, but like, I'm not going to blame them for pushing for more for their client. Cause guess what? I would do the same thing in my shoes. I'm not saying I would try to be sneaky about it. I'm just saying it's a contract. It's a business negotiation. It's an arm's length transaction is what we call it. Right. So you're on the same playing field as me, especially when you're dealing with big investors and big investments. Everybody's a sophisticated party. So it makes it that much more important to have your own representation, your own counsel, somebody in your corner who actually is looking out for just one person, which is you, not looking out for the whole partnership or for the sponsors or whatever. So, I mean, I think that's an important one. One thing that I've seen come across my desk is, people putting in money, thinking it's for one investment, and then they can't close, the sponsors can't close on that, or they back out for whatever reason. And then they kind of struggle to get that money back. They're like, well, we don't want to go into this other investment that you guys are looking at. So, I mean, it seems pretty intuitive that if I put my money in for, this property here and we don't close, I should have the right to my money back. That's something that I've seen as an issue, and we were able to get the client's money back, but only after I got involved, which it shouldn't be like that, but you never know. So like, it's little things like that you really have to look out for.
No, yeah, absolutely. And I think that that's, a great point to bring up is that, if something doesn't, come to fruition, it doesn't, actually materialize, like what happens at that point? Because there might be something in there that says, there's a hold period for, non-materialized deals. I mean, I personally haven't seen that, but it's not outside the realm of something that might get put in there. And that just kind of boils down to, again, these these documents should be detailing all of that. And if they don't, having someone that has the, sharpness and acuity to say, hey, like this is missing. Like if, this doesn't happen, then why is that being put in there? This could cause this issue for you. Whereas, someone says, oh yeah, it didn't materialize, I assume I just get my money back. And they don't even think to kind of read that margin or that footnote, that little one that's there, and then go to page 3 and look, okay, here's where it's defined. You just aren't looking for that. So again, having representation, and you also bring up a good point too, is that these general partners and these managers are operating in a collective best interest, not specifically yours. Their main goal should be to preserve capital, to create returns in a safe and effective a manner as possible, given the market conditions. That's kind of the high level like definition of this if you read it in a textbook. But they're not necessarily looking out for what's in your best interest specifically, and is this a good or feasible investment for you to be doing? At the high level, are you accredited? Do you meet the standard? Great, give us your money. So having someone that can actually review this stuff is very important. And I guess the last question I would go, did you have some?
No, I was just going to say when you're making money, everybody's interests seem to align. And then when things fall apart, nobody's interests seem to align. So it's very important. I just wanted to harp on the last thing you said. It's like, it's very important because you think you go into this and everyone's on the same page. And again, they are when things are good. And then when things go bad, I've seen some ugly things happen when things go sideways. So just make sure you're protected. It might be a little awkward in the beginning. It might be a little uncomfortable to have the conversations and to, have a little bit of conflict, but I promise you that it'll be worth it. If anything were to happen, that's absolutely worth it.
Yeah, and especially, the more experienced investors are, and that's a really great point, I think, to kind of end on. And we kind of touched on a little bit of the psychology here, on everything that comes, especially when it comes to asking questions. But keep in mind, like, be able to ask the hard question. Don't be afraid to ask an investment provider, say, hey, look, again, using a little bit of hyperbole, it was like, what happens if you get hit by a bus? What happens if literally everything goes wrong and your other two partners, are unavailable to be reached, or again, they get hit by buses? What happens if these things happen? How many deals have you done? Have they gone well? How do you feel they went? Would you mind if I talk to another investor that's invested with you? Again, being the $100,000 investor and the the $20 million investment, again, you might not necessarily get as much, feedback on that. But again, just don't be afraid to ask those questions. If you start offending people by asking these questions, that should be something that might play into your comfortability level in doing this.
Yeah.
I had a client yesterday that was like, hey, I don't want to offend you or anything, but would you mind telling me what happens if Advanta IRA goes out of business? What happens if there's fraud committed? And I cherish those questions from my investors because it's something that, I feel like more people should ask. And I'm more than happy to tell people exactly in painful legal detail what kind of happens in those.
And that's a green flag.
Just, if they're willing to answer those questions, or at least, point you in the direction, if again, small fish, big pond, and to say, hey, you know what, here's where it's all laid out for you, as far as like worst case scenario things that could happen, or having an attorney that can say, hey, look, here's where they detail all of it. Here's maybe a few questions that you might want to ask to them specifically just to get some clarity on. Again, be afraid to ask the hard questions and use that to kind of temper yourself in your due diligence on, do you feel like you're getting good answers from these people when you ask a hard question?
Yeah, no, I agree with you 100%. If you're asking a question more than once and you're not getting a straight answer, that's a red flag for sure.
Absolutely. Well, again, that kind of brings us up to the hour that we have scheduled for this. Again, I really do appreciate your time. If people, certainly are an attorney that deals in this kind of stuff. If people are interested in engaging you for legal services or want to learn more about what you have on your legal practice side, I think you also said you are a real estate broker as well. How can they reach out to you? How can they find you?
So if you're on social media, I'm at Attorney Bishoy. That's Attorney Bishoy. That's Instagram, that's TikTok, that's YouTube, and then LinkedIn. You just search my name as it's spelled down there. And if you want to shoot me an email, it's Bishoy, Bishoy, at Levacy Legal, LEV like Victor, ACY, legal, legal.com. And the law firm is Levacy Legal, so levacylegal.com.
All right, fantastic. Well, again, most valuable asset we all have is our time. Can't make any more of it. So thanks for taking the time out to chat with us today. Again, this has been the Alternative Investing Advantage podcast. My name is Alex Perny, and thanks for joining with us. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.